You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 13th of July 2025. I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing primary health properties, Mulberry, Greggs, Baltic Classifieds Group, Sainsbury's, and our US company of the week is Ashtead. John, do you want to kick us off with primary health properties?
Yes, so primary health properties, we've covered it a number of times on the show. It's one of the big two GP, essentially real estate investment trusts, along with Ashtead Group. And they had a trading statement out last week with the group reporting a 3.1% rise in the first half net rental income, with growth largely due to extra rental income from the rent reviews. Underlying profit rose 2.2% to £47.3 million. And the group has 43 active asset management projects underway, compared with 37 back in December. And the investment portfolio rose by 0.7% in value, ending at £2.8 billion, with a loan to value of 48.6%. And dividends totaled 3.55 pence per share for the half, up 2.9%. And a third quarterly dividend of 1.775 pence per share has already been declared, which is due to be paid in August. And the shares were broadly flat. I think the big news which has come out in the last couple of months with primary health properties is that their competitor, Ashtead Group, which has a slightly larger market cap of 1.6 billion compared with primary health properties 1.2 billion. So Ashtead Group had a bid from American private equity, and then that drew primary health properties in to put a bid in for Ashtead Group. And that bid has now been accepted. So it's essentially going to be, I think it's cash and shares, and it's going to form one big real estate trust. And together it'll be the largest by a huge distance and own nearly 14% of all GP surgeries in the UK. It does have exposure to Ireland, and I'm not sure what percentage it is over there, but in the UK it's around the 14% mark. And I think that is the really big news. If we look at it in terms of valuation, primary health properties, as mentioned, has a market cap of 1.2 billion, and with Ashtead Group, it's 1.6 billion. So the combined value will be around sort of 2.8 billion. Primary health properties trades at 0.89 forward price to book, which compares with the 10-year average of 1.14. And it has a prospective dividend yield of nearly 7.5% compared with a 10-year average of 5.2%. I think this is really quite interesting, particularly given that they'll have a combined market share of nearly 14%. I actually thought it was potentially would have been higher, but I think it's particularly interesting because there's a tendency in primary care of GPs not wanting to own buildings, i.e. their own surgeries, and wanting to have them on leasehold. And I think potentially with that, you've got a lot of surgeries that the combined entity would like to acquire at probably not very expensive valuations, particularly if you've got the scenario where you've got older GPs who are retiring and just want to offload. So thereby you've got room to grow the portfolio by almost organic means rather than just the rent rises. And I think probably at fairly lowly valuations, which is ideal for the group. Again, if you look at the valuation of both Ashtead and primary health properties, I think you've seen it come down quite significantly over the last 5 years as interest rates have risen. And arguably, if you've had the bond proxy argument with some of these real estate investment trusts, then that's become less appealing when you can get risk-free or essentially risk-free return on gilts. But now I think you are seeing it at nearly 7.5%, which is definitely a premium. I think it's very low risk with primary health properties. I think it's become lower risk again over the last 5 years. I think if you looked back to it and you had sort of the Corbyn era under Labour, this would have absolutely been a target for nationalisation. That threat seems to have really disappeared. And the government are backing about 90% of the rental income here. They've got rental rises almost sort of built in with 2 yearly rent reviews. They don't own so much of the market share that you would think that, if they had a monopoly on it, the government might look to change that. It's nowhere near that at 14%. So you'd think that those rent reviews are fairly safe. I suppose from a risk perspective, there is a fair bit of debt there, although I think you'd argue if it's sort of 90% of the rents essentially coming from the government, and you've got a lot of very long-term leases in the 20 to 30 year range, that does mitigate things somewhat. And maybe there's an outside possibility that you do have a reform government or a more left-leaning Labour government, and there's that sort of risk of nationalisation. However, that does seem fairly low. And I think if you've got a dividend yield quite that high, I think it's actually probably more attractive. And I think, that the combined entity, arguably, I think Primary Health Properties has had the slightly better numbers over the last few years. And if they're able to get Assura and sort of turn it around a bit with their management and perhaps cut some fat out of it too, again, I think it could be pretty appealing. Sam, what are your thoughts on this merger?
I think Primary Health Properties is probably the most attractive we've ever seen it, or certainly that I've ever seen it. I think the yield looks good. I don't think 48% debt to equity is outrageous, especially, like you say, when you consider it's long-term contracts backed by the government. I think that seems okay. I think the prospective yield of 7.4% is very attractive, and I think you could do a lot worse. It's comfortably above what you get from bank interest or gilts or whatever else. And I just think because of the makeup of that portfolio, it's not inherently that risky. I think in terms of the merger, I think it makes a lot of sense. I agree 14% market share is pretty low for the biggest player, but you have to strip out, I don't know what proportion of GP practices own the buildings themselves. So when you strip them out, I'm going to make up a number, but say it's half of them own it, it might be more like 28% that are actually leasing from PHP. And yeah, there's probably still a decent opportunity to continue expanding the portfolio. So I think there's a lot to like. The only issue is I've got Supermarket Income REIT, and there's quite a few attractive REITs at the moment. For example, we did Tritax last week. But yeah, I think it looks really attractive. Is it something that you'd be considering?
Potentially. I think it's that how much the dividend yield has ticked up. And I suppose it's reflected that, the share price has come down a fair bit. And I think it's down 43%. Let me just have a quick look at the charts. Yeah, so when it peaked in summer 21, it's down about 42.5% since then. And yeah, in the last year, it's basically flat. In terms of the deal structure, so it's mixed cash and share offer, and it's 0.3865 of new Primary Health Property shares for each Assura share, 12.5 pence in cash per Assura share, and a special dividend of 0.84 pence per Assura share as well. And I think if the trend continues that a lot of GPs don't want to own the buildings, and they're those sort of ones, maybe there are financial reasons that they need to raise cash or that they're retiring, you'd think that they could get it and get quite attractive prices. I think that's another thing. And if they're public company and they've got a lot of access to their capital, then it's, again, they could do a lot with it. And I think, the 10-year plan for the NHS was out as well, and they're keen for more things to be delivered in the community locally. And therefore, you'd think the sort of facilities that need to be developed are these GP surgeries, potentially bigger GP surgeries, potentially having space for other things within them. And I can't imagine central government wanting to do it directly, or the NHS wanting to do it directly themselves. GPs certainly aren't going to do it themselves. And therefore, you've got that sort of gap for Assura. And if they're signing people, whether they're sort of directly employed by the NHS or not, up to 30-year leases, I mean, that's pretty good.
Yeah, I think it's very, very attractive.
How's Mulberry doing? Is it a similar story to Burberry?
Unfortunately not. I think they'd really love to be in Burberry's position, and Burberry aren't doing particularly well themselves, but unfortunately Mulberry, as we will see, are doing even worse. So Mulberry have come out with their results for the 52-week period ended March 2025. This tells you the direction they're heading in pretty quickly, but as well as the results, they've also announced a subscription for convertible loan notes by two major shareholders, raising 20 million, and they've done a retail offer for a further 1.2 million for minority shareholders. They're basically having to raise more debt at the moment. In terms of the figures, revenue was down 21% to 120 million, cost of sales were down 12%, gross profit was down 25% to 80 million. The operating expenses were up 17% to 107 million, and the operating loss improved by 8%, so they just lost 27 million this year on revenue of 120. There was £5 million of finance expenses as well, so that gives a loss before tax of just under 32 million, which was 7% lower than last year. Included within that was a restructuring cost of 3.1 million. However, if you strip out all the restructuring costs, these results are still absolutely terrible. So if we look at revenue a bit more, digital revenue was down 14%, in-store revenue was down 22%, and that's for the group as a whole. If we go through by geography, UK digital revenue was down 17%, stores were down 22%, North America digital was down 8%, stores were up 16%, so that gave a net decline of 1%. For Asia Pacific, digital was down 28%, stores were down 33%, and that gives a total decline of 32%. And for the rest of the world, digital was 26%, but that's a very small base, and stores were down 2%. If you look at cash flow, which I think is pretty important given the current state of the business, they had cash generated from operations of 8.7 million, but the operating cash outflow is 11 million. However, they had positive movement of working capital of 19.6 million. They'd also had positive movement in working capital of 16 million last year. However, reducing the working capital is a trick you can only play so many times, and at some point you'll run out of inventory to get rid of. That's not really very sustainable. As we mentioned, interest was 5 million. They had 10 million come in from proceeds of share issues, so they've obviously done a recent equity raise as well as the debt they've just announced. They had a supply financing agreement of just under 10 million, and overall there was a 1.1 million net cash increase, but they've had to raise a load of money and they've had to cut working capital down. They had cash on the balance sheet at the year end of £8 million, which I think if you look at just the operating cash outflow, that was 11 million. If they hadn't just done the 20 million raise, or if they weren't about to do the 20 million raise, they'd probably do well to make the cash last for a year. So I think it's really bad. In addition to the results they announced in June, that they also announced their fundraising 20 million, as we've mentioned. They've tried to put a positive spin on it by saying it'll be used to accelerate the growth strategy, but there is no growth. I hope there's strategy, but I think really it's just to try and stay afloat. And I think if you're trying to just cut the decline, I wouldn't call that a growth strategy. But I guess they do have to try and put a positive spin on it. In terms of the strategic highlights, they've been simplifying the company. They've got a new commercial agreements with premium department stores, including Liberty Flannels, Harvey Nichols and John Lewis. They targeted international expansion via retail partnerships with Nordstrom in the US and David Jones in Australia. They're refocusing the stores on the UK and the US markets with a closure of 12 loss-making stores in Asia. And they've already delivered 5.9 million of annualised gross cost savings. In the outlook, they've said trading to date has been in line with expectations, and for the 9 weeks to 1 June, revenue as a whole declined by 18%, and digital revenue declined by 17% on a total basis, reflecting the impact of the full closure of loss-making and underperforming stores. On a like-for-like basis, that decline was only 5%. The group's continued focus on optimising its store portfolio is expected to deliver a further £2 million improvement in underlying EBITDA. Within this performance, the group's focus on the UK and North America showed an improving trend in like-for-like performance, trading only 1% and 5% behind the prior year respectively. In terms of valuation, the business trades at a market cap of just 64 million. Interestingly, I don't know if it's because the market's quite small, but there's a huge spread on this. So to sell shares would be 85p, but to buy one is £1. It's not normally that big. There's no earnings and there's no dividends. So yeah, I think it just looks like they're in a really, really bad position. It reminds me of when we used to look at Ted Baker's results, where you feel like virtually every metric is moving in the wrong direction. They can get rid of stores that are really losing the cash, but even then the core business, they've highlighted the UK and the US, but it's still declining. It might be slow to decline, but it is declining. That being said, I think with the 20 million, if they can raise that, they probably have enough cash to keep them ticking over for another couple of years, but I don't really see what gets them back to growth. It would just feel like catching a falling knife, and I just wouldn't touch it. What about you, John? Anything positive?
Yeah, same. I mean, uninvestable. I was going to add, do you think this is for Fraser's Group, maybe?
I think the problem is it's performed so poorly. I'm not even sure that Mike Ashley would want it. So I think they let Ted Baker go bust. They didn't buy that one, so they don't buy everything.
I think they did let that go, yeah. I think Ted Baker just doesn't exist.
Because I think the issue is this just reminds me a lot more of a Ted Baker than a Debenhams.
Yeah, well, Debenhams still lives on through Boohoo.
But I think at least with the equity, the debt raise, at least they've got probably a couple of years worth of cash, and I think that gives them a chance to turn it around at least. It's not immediately going to go bust, but I don't think it's something you'd want to own, though. It's not really a turnaround strategy I'd back.
Okay. Should we move on to Greggs?
Yes. How are they doing?
So they actually had a trading statement out for the 26 weeks ended 28th of June last month, and they reported first half sales growth of 6.9% to £1 billion, falling well short of market expectations of 14% growth. Like-for-like sales in company-managed shops rose 2.6%, consensus was 2.9%, with growth slowing in June due to the hot weather impacting footfall. There were 31 net store openings in the period, taking the total shop count to 2,649, and the group remains confident in delivering between 140 and 150 net store openings this year. First half operating profit is expected to be below last year's level of £75.8 million due to a tough comparable period and the unfavourable timing of store refurbishments. For the full year, the cost inflation outlook remains unchanged at 6%, and cost-cutting initiatives are set to help second half performance. Despite this, Greggs now expects the full year operating profits could be modestly below 2024's level of £195.3 million against the consensus of £198.5 million. And the shares were down nearly 13% in early trading. In terms of valuation, Greggs has a market cap of £1.7 billion and trades at 14.4 times forward earnings, compared with the 10-year average of 22.8, and it has a prospective dividend yield of 3.5%. And it's worth mentioning, yes, the shares were down nearly 13% on the day. They're down 40% over the past year. I mean, I think it's definitely disappointing for the group, and they are falling behind the consensus, so hence you are seeing a significant drop in the shares. I do think that we've sort of kind of come to expect some of this slowdown with Greggs. We felt that it's become much more saturated, and we debated a few years ago at what point that came. I think it came later than we were probably expecting, but it has now really come. And you're seeing that reflected in the share price and in the valuation overall. I think actually, if you look at it as a more mature business, and yes, probably prospects for growth are much lower, they have done extended store hours and the franchise operation has grown too. But I think if you do look at it as a more mature business with a lot of growth behind it, still definitely some to come, but a lot of that rapid growth behind it, I think it actually, at the current valuation, much more attractive than it's been for a long time. And arguably, I think you could suggest that it might deserve the watch list on that basis. I think I'm certainly anchored to the price it was at a few years ago with the growth that it was delivering back then. And I think having seen where it's reached now, probably wouldn't buy it. And yes, there is scope for that dividend to be increased. However, there are some of the headwinds coming with the national insurance, minimum wage hikes, and then you wonder what's going to be in the budget for this autumn. So I think on balance, it probably isn't one for me. but it's the cheapest we've seen it in a fair while. What do you think, Sam?
I just don't get why they've issued a second statement. So looking at it, we covered their statement at the end of May, and they've just come out with another one. So it looks like the first one covered the first 20 weeks of the year, and the second one covers the first 26. So I just don't really see the point. I don't management have something better to do with their time?
Just looking at it. So yeah, they did it definitely. So they came out with it on the 2nd of July, and the shares were £19.75 a share. And then they did drop. In fact, by the 3rd of July, so in fact, they dropped 15% on the day.
Okay, so looking at it, there are some slight differences. So they read pretty similar, but there's some slight differences in the figures. So in the first one, it says the board's expectations for the full year outcome remains unchanged. The second one says they now anticipate the profit could be modestly below that was originally predicted. But I just don't get how that could have changed in 6 weeks. Surely they had the information 6 weeks ago. I just think it reflects really poorly on management and the board. I just think it's embarrassing.
Yeah.
But anyway, it is what it is. But in terms of the business, I think for 14 times earnings, it's the cheapest we've seen it. I think it's kind of back to where it was kind of almost pre-COVID. I know you're not getting the growth that you were. I just think for me, 14 times earnings without the growth is a bit pricey. There is a price at which I'd be interested, but I think assuming there's no growth and the growth story's over, which it might not be, it could bounce back, but assuming that growth story's over, I think it's pretty saturated. I'd had kind of a figure in my head of around 10 times earnings. I just don't see where the growth comes from. I think they've picked a lot of the low-hanging fruit, like with the store hours and stuff, because I think they've probably done that in the easier stores to do it in. A lot of the ones that are left, although it's like 50%, I think it's probably the harder 50%. But yeah, if I could get it for a PE fairly close to 10, I think I'd be quite interested in it. But 14 just seems a bit much.
Fine. Okay. How are Baltic Classifieds doing?
Unfortunately, they're doing really well. I say unfortunately because it's a business I would love to own, but it's always just been too expensive. So for anyone who's not familiar with Baltic Classifieds Group, they're listed on the FTSE, but they are basically the Auto Trader, the Rightmove and the Indeed.com of the Baltics. So they have come out with their half-year results, and revenue was up 15% to €82.8 million, and all these figures are going to be in euros. If we break that down, auto revenue was up 14% to 31.4 million. Real estate revenue was up 23% to 22.2 million. Jobs and services revenue was up 15% to 16 million, and generalist revenue was up 5% to 13.2 million. The EBITDA was up 17%, 64.4 million, and the EBITDA margin was up 1% to 78%. The operating profit was up 40% to 53.5 million, and the profit for the year was up 40% to 44.8 million. The earnings per share was up 42% to 9.3 cents, and the adjusted basic earnings per share was up 23% to 11.3 million. The cash generated from operations increased 13% to 66.8 million, and the cash conversion rate remained at 99%. They voluntarily repaid 25 million of debt to end the year with a gross loan balance of 25 million. Net debt reduced to 3.6 million, and that's down from 27.5 million a year ago. And they ended the year with a year-end net debt to EBITDA ratio of 0.1x compared to 0.5x a year ago. They've said they have a clear capital allocation framework with 29.4 million returned to shareholders, and of that 15.9 million was dividends and 13.5 million was buybacks. That 29.4 total returned compares to 32.6 million a year ago. Operationally, they've maintained a strong leadership position compared to their nearest competitor across all the largest sites, which together account for 90% of revenue. So Autoplius.lt is 6x the nearest competitor. Auto24.ee is at 36x, down from 40x. Arudas is at 27x, up from 18x. KV.ee plus City24.ee is at 13x, down from 16x. CVBankers.it is at 5x, down from 7x. And Scaleview is at 21x, up from 19x. At the start of the year, they implemented a consumer-to-consumer pricing and packaging change across all business units, which combined with rising market prices of the goods and services on the site have resulted in increased yields in all business lines. Yield growths per listed ads were 21% in auto, 22% in real estate, and 17% in generalist. In services, revenue per active ad grew 14%. On January 1st, the Estonian government introduced a new vehicle transaction and ownership tax. November and December 2024 saw a marked increase in transactions as dealers and consumers anticipated the change. However, the slowdown post the tax increase has been deeper and longer than expected. Used car transactions have been consistently down over 40% year over year since implementation. This has had a material impact on both the consumer-to-consumer and business-to-consumer revenue streams of Auto24, reducing January to April group revenue by 3 to 4%. They saw an increase in business customer activity across the platform in the year. Auto dealer numbers remained stable, while the number of real estate brokers and jobs customers rose by 4% and 1% respectively. Traffic to the sites averaged 57 million visits every month, meaning that on average, a resident in the Baltics visited their sites 9 times every month. In terms of valuation, the business trades at a P ratio of 36.5 and it has a dividend yield of 0.9% and a market cap of 1.74 billion. I don't think there's really anything to criticise here. You could maybe criticise the auto side because of the new tax, but I don't think that's really their fault, and I think eventually people will start buying new cars again. So yeah, it's really just a valuation. I think it's a fantastic business. I would really love to own it, but I just can't justify paying 36 times earnings for it. What about you, John?
Yeah, I think I'd largely echo that, to be honest. It's valuation. Otherwise, everything else about the business is spot on.
I think for me, it's like, with Rightmove, for example, I owned that, but I got it at 25 and I was a bit uncomfortable. So to go and pay 35 in a market I don't know, where although it's dominant, I've no idea how big the Baltic market could be. It's just a business where, unfortunately, I'd love to own it, but I just have to wait. I'd have to wait for it to come down, really. So shall we move on to Sainsbury's?
Yeah, absolutely. So it's one of the 2 listed UK supermarkets. They had a Q1 trading statement out last week, with like-for-like sales, excluding fuel, growing by 4.7% in the first quarter, and that was ahead of market forecasts of 3.4% growth, driven by better than expected uplifts in grocery and general merchandise. In grocery, market share gains were helped by both its online and convenience channels, growing by 6%, and a strong performance in its Taste the Difference range, up 18%. General merchandise outperformance was driven by favourable weather and a weak comparable period. Full year guidance has been reiterated, pointing to retail underlying operating profits of around £1 billion and retail free cash flow of more than £500 million. Shares were up nearly 2% in early trading. In terms of valuation, Sainsbury's has a market cap of £6.43 billion and trades at 12.6 times forward earnings, compared with the 10-year average of 11.9, and it has a prospective dividend yield of 6%. I thought this was a really good trading statement. They're doing very well. The turnaround is going, as you can see, very well. And I think they've also benefited from the withdrawal of, Morrison's going to private equity and Ashtead going to the Isa brothers. I think this has allowed Sainsbury's and Tesco's both to kick on and both to gain market share. And Sainsbury's certainly looks like a much slicker operation. I think it very much follows the Tesco's model, although I think Tesco's, when it got very bloated and tried to grow in the States and it was acquiring cafes and gyms and all sorts, Sainsbury's didn't go quite that far, but it did buy Argos. And now I think it kind of back to basics. They're competing on price. They've got the supply chain, etc. sorted. And those discounters that hit them in the early noughties, that's not happening now. And a bit like Tesco's, it's got the sort of higher end when it comes to like Taste the Difference, but then it can also compete at the kind of more basic end and have Aldi price match. And I think you're seeing it sort of that back to basics approach working for them. So it's probably not a stock for me, but as an income investor, you can see it's quite appealing.
I would agree. I think it's pretty attractive. I think it's interesting as well because I've had a quick look in terms of the market share, because it's really interesting that Sainsbury's and Tesco are both doing well, and it looks like the market share gain is specifically coming from Asda. Apparently, Asda's market share has dropped from 13.7 to around 12 to 12.5 in recent periods as they struggle with debt, IT system separation and competitive pressures. I don't think it's hugely surprising. It is rare a company gets bought out, loaded up with debt and somehow becomes a better business. In terms of the PE, forward PE of 12.6, I don't think it's outrageous. I think the dividend yield's quite attractive. I think, in fairness to Sainsbury's and Tesco, they've both had to perform despite the opportunity being there from Asda. They've both done very well to take it.
Okay, fine. On to our final company of the week, Ashtead.
Yes, so Ashtead, for anyone who's not familiar, they are the owners of Sunbelt Rental, which is they basically hire out diggers and stuff like that. So you'll see Sunbelt Rentals on a lot of construction sites. They have come out with their full year results, and full year revenue fell 1% to 10.8 billion, with rental revenue up 4%, ignoring currency moves. Underlying operating profit fell 3% to 2.7 billion, and I should say all these figures are in dollars. Revenue dropped 4% in the fourth quarter to 2.5 billion, and that's lower than the 2.6 that was expected. Free cash flow rose from 216 million to 1.8 billion, and net debt improved by 324 million to 10.3 billion. The group expects rental revenues to grow 0 to 4% for the new year compared to 3.5% expected, and to deliver 2 to 2.3 billion of free cash flow compared to 2 billion expected. Shares fell 1.4% following the announcement. And for background, they've been expanding quite a lot recently, and they've probably overspent a bit, and that's coincided with a bit of a slowing market. However, on the US side, they are doing it really, really well, and they're doing really well with a lot of the publicly funded projects where they've got about a 30% market share in the US. As we've discussed previously, they have announced that they're looking to move their primary listing to the US, but they have also announced that there'll be a secondary listing still in the UK, which is quite convenient because we can then decide whether we want to cover it as a US or a UK stock. In terms of the valuation, the business trades at a forward P of 15.1, and that's bang on the 10-year average. It has a prospective dividend yield of 1.9%, and that's slightly above the 10-year average of 1.7%. I think they're a really good business, but it's just, for me, it's not a business that interests me. The main reason is, although they're a very, very good operator, it's a very capital-intensive business. They have to spend a lot of money on the fleet and maintaining it and renewing it, and then it depreciates really quickly. So you're just constantly ploughing capital back in, and it's just not the kind of business that I particularly want. What about you, John? Any thoughts?
No, pretty similar. I think it's the capital intensity of it that puts me off the investment case, but very well run and well done.
In that case, of the 6 businesses we've covered this week, Primary Health Properties, Mulberry Group, Greggs, Baltic Classifieds Group, Sainsbury's and Ashtead, which do you like the most and which do you like the least?
Fairly easy one. I would go for Primary Health Properties as top pick, and Mulberry is an easy bottom.
I'm going to be boring and say the same, but I do think Baltic Classifieds Group is the best business. It's just too expensive.
Yeah.
But yeah, I think Primary Health Properties, I think that looks quite attractive at the moment.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.